Good morning from London. It is just after 9 a.m. on Friday, the 29th of January, and here begins our roundup of the week just been. With Asia now closed for the month and just one trading day left in Europe and the US, we have a pretty good idea of how returns are shaping up for the month, barring, of course, some very big moves in the next 14 hours or so, which cannot be discounted when we think about some of the odd behavior we are seeing in markets currently. More on that to follow. Developed markets look set to finish the month slightly down, with the UK leading from Japan and the US, and Europe the laggard on this occasion. On the other hand, emerging market equities, well, they may well post gains of around 4%, led by China. From a sector perspective, energy looks to be the big winner, with Brent crude, the international benchmark oil, looking set to hold on to gains of around 8%, with barrels trading at around $55. Government bonds then, currently on course to finish the month slightly down, with better returns available in credit, and indeed inflation-protected bonds posting better performance, with real rates largely unchanged, even as rising inflation expectations have driven nominal yields higher. Now, clearly, the vaccine rollout is the key factor, not least of all for individuals, but for economies and by extension for markets. And therein, we've had reports of vaccine shortages in Europe as well as in the US. Some questions over the efficacy of some of the vaccines, particularly German regulators deciding not to permit the use of the AstraZeneca vaccine in the age cohort of people over 65, due, in their view, to a lack of data on its effectiveness. On the other hand, however, some strong positives coming out of Israel, which is leading the way in terms of inoculating its population, and their infection rates in the vaccinated population have been coming down quite dramatically. Overall, our view is that there are always going to be logistical issues as we go about trying to inoculate a large part of the 8 billion people in the world. Currently, we are not overly concerned with progress. In terms of economic data, it's been mixed, I would say, over the last week. We had a disappointing durable goods order print out of the US, but on the other hand, again, in the US, we saw fewer new benefits claimants and a decrease in the number of continuing claimants. Overall, were to look at the balance of data releases coming in, they continue to be ahead of expectations. At a more micro level then, with around a third of S&P 500 companies having reported on earnings, we're seeing decent beats, both on earnings and also on headline revenues. So for the third quarter in a row, a reasonable outcome, it seems, for companies relative to quite low expectations. Those then, and it's a quick roundup of those, are the data points that we think are important. Overall, they don't alter our view of the world, which, as you have heard us speak about, is largely constructive. A quick comment, however, on the Wall Street bets traders, who I'm sure you've been reading about, and that's despite the fact that at this stage we wouldn't consider this behavior systemically important. For those who don't know, this is a group of traders who are targeting popular hedge fund shorts, so they'll drive up the prices of stocks that hedge funds believe should in fact be going down. And when you look at the volume of shares that have been traded, if you look at the price moves in some of these companies that they're targeting, it clearly warrants attention because the moves have been dramatic. For us currently, as I say, we are monitoring, but it largely just serves as a reminder that when building strategies and equity strategies in particular, it is important that they are designed in order to be able to withstand mark-to-market losses without being forced out of those trades and forced to crystallize those losses and essentially make them real. And with that, wishing you a very pleasant end to your week and looking forward to the weekend to come.